Hey, so let's talk about something that's probably been stressing you out lately. You've looked at your safe investments, the ones you bought specifically to avoid losing money, and you see that they're, well, losing money. It makes no sense, right? Well, let's break down exactly what's going on.
And look, I get it. It's completely normal to feel frustrated, maybe even a little betrayed. For years, the deal seemed really simple. These products were just a slightly better version of a bank deposit. You got a bit more interest, and you could sleep at night. So seeing that value drop feels like someone just changed the rules of the game overnight. It's a real shock. So that's the million-dollar question, isn't it? Why is this happening, and why now? To really get to the bottom of this, we need to pop the hood on these products and see what's actually inside. We need to understand what you really own.
Okay, so first things first, when you put money into one of these so-called safe products, it's not just sitting in some high-tech vault with your name on it. No, that money is being put to work. But how?
Here's what's happening. You're basically handing your cash over to a professional manager. They take your money, pull it together with money from thousands of other people, and create this one giant pot of cash. And with that giant pot, they go out and buy one thing, almost exclusively: bonds. So you really got to stop thinking of this as a savings account. It's much more like a fund that is obsessed with buying bonds. And that right there, that's the key to this whole thing. The performance, the safety, and yeah, the recent losses. It all comes down to the bond market. I promise you, once you understand the simple mechanics of how bonds work, this whole confusing mystery just dissolves. All right, let's get into the single most important rule in the entire bond world. Now, it's a little weird at first, it might feel backwards, but once this clicks for you, everything else is going to make perfect sense. So here's the big secret. When interest rates out in the market go up, the price of existing bonds goes down. And on the flip side, when market interest rates go down, the price of those same existing bonds goes up. They always move in opposite directions. The best way to think about it is like a seesaw. You've got interest rates on one end and the price of your bond on the other. When one side goes up, the other side has to go down. So why does this happen? Well, imagine you own a bond that pays you a nice, steady 3%. But then all of a sudden, new bonds are being sold that pay 4%. Well, who would want to buy your 3% bond now? Nobody. So if you want to sell it, you have to drop the price. You have to sell it at a discount to make it attractive. Its price falls to compete. And that is the seesaw effect in action. So we know these products are just jam-packed with bonds, but who is actually in this market, buying and selling all day? You know, this is another huge way it's different from the stock market, and the answer might actually surprise you. You see, when you think about the stock market, it's driven by everyday people. You know, retail investors like you and me make up something like 80% of it. The bond market? No way. It is the complete opposite. This is a world of giants. Banks are by far the biggest players, holding around 60%. And your wealth product? It's in that next big slice of the pie, the asset managers, who hold about 30%. Regular people? We're not even a rounding error here. And all these big players, they are not playing the same game. You've got the banks over here who are super conservative. They just want stability, so they buy the safest government bonds and pretty much hold them forever. On the other end of the spectrum are securities firms. They are aggressive traders trying to turn a quick profit. And your investment? It's sitting right there in the middle. The whole goal is to get you a better return than a boring bank deposit, so the managers buy slightly riskier bonds. They're in that moderate camp, taking a little more risk to try and get you a little more reward. So how exactly do the managers of your product get you that extra return? How do they squeeze out that little bit of extra performance that makes their product look better than the bank? Well, they have a few tricks up their sleeve, a few things we can call their magic weapons. They really have three main strategies. First up is leverage. This is basically like getting a mortgage for your investment. They borrow money at a low rate to buy more bonds that pay a higher rate, and then they get to keep the difference. Second, they add duration. Now that's just a fancy term for buying bonds that won't mature for a long time, because those usually pay more interest. And third is something called credit sinking. This just means they buy bonds from slightly riskier companies to get a higher payout. Now each of these weapons is designed to juice your returns. But, and this is the important part, each one also quietly adds another layer of risk to the whole thing. Okay, so we've laid out all the pieces of the puzzle. We know what your investment is, we know about the bond market seesaw rule, we know who the big players are, and we know about their magic weapons. Now, let's connect the dots and see exactly how this all came crashing together. This is it. This is the moment it all makes sense. What was the one single trigger? the one event that turned all of those quiet, hidden risks into very real, very painful losses. It was a perfect storm, a chain reaction, and it all started with just one thing. Market interest rates began to rise. So what happened next? Well, because of that seesaw rule, the price of all the existing bonds in your portfolio immediately started to fall. At the exact same time, the cost of borrowing money, that leverage weapon, went up. And to top it off, those longer-term bonds they bought, they are extra sensitive to interest rate changes, so their prices fell even harder than the others. All three hidden risks were exposed at the exact same moment, and that's what caused the value of your safe investment to drop. So here's the most important thing to take away from all this. These products were never truly risk-free, in the same way a government-insured bank deposit is. They were always lower risk. For a long time, the market was calm, so those risks just stayed hidden under the surface. But the recent change in interest rates didn't create new risks. It simply made the ones that were there all along visible to everyone. And that brings us to the final thought. Look, this isn't about panicking. Not at all. It's about being informed. Now that you understand how things like leverage, duration, and credit risk actually work, you're in a much better position to judge your investments. So the real question to ask yourself now is, with this new knowledge, how are you going to think about that age-old trade-off between keeping your money safe and making it grow?